I want to talk about adjusting entries just a minute. Kind of give you a little bit of background foundation so that adjusting entries don't surprise you or confuse you. So first of all, adjusting entries are made at the end of an accounting period, at the end of a month, quarter, or year. And adjusting entries have to be entered because of timing differences. For example, we might pay cash ahead of an expense like prepaid insurance or supplies. We might receive cash ahead of earning the income. Somebody pays us ahead of time for a service that we don't provide till later. We pay rent ahead of time, or we receive rent ahead of time. So in most cases, if we receive if we pay money ahead of time, we would credit the cash account, of course, and then we would debit an asset account. For example, we pay money for supplies, so we debit supplies, credit cash. Nothing has gone to the income statement yet. At the end of the period, though, those supplies may have been used up, and so we need to adjust that asset account and the expense account. So each adjusting entry affects at least one income statement account and at least one balance sheet account. So that means that in every adjusting entry at one revenue account, at least one revenue account, or at least one expense account, and usually it will be one revenue or one expense account will be in that entry, and an asset or a liability account will be in that entry. So there's going to be at least one revenue or one expense, and there will be at least one asset or one liability account every time. Here's a couple of things to remember. You can never adjust cash. Cash cannot be adjusted. It's tempting, like a show here, to want to include cash in your adjusting entries, but you can't. Cash can never be adjusted. You can't adjust long-term assets. You can't adjust buildings. You can't adjust vehicles. You can, however, adjust the associated accumulated depreciation accounts. And then common stock, retained earnings, and dividends are all off limits. You don't adjust those accounts either. Okay, there are two types of adjusting entries. There are what are known as deferral entries and what are known as accrual entries. A deferral entry always involves some entry that has happened in the past. Think about cash having been exchanged prior to the year end or the period end. For example, we buy supplies. So when we buy supplies, we usually debit a prepaid asset account called supplies. At year end, we count the supplies. There are fewer supplies on hand than the amount shown in the account, and so we have to decrease that asset account, supplies. That means a credit. We have to increase the associated expense account, supplies expense. So we would debit supplies expense, credit supplies. Again, go back up here. Each adjusting entry must include one revenue or expense account and one asset or liability account. In this case, it includes an asset and an expense. The asset is being reduced and the expense is being increased. Insurance. Let's say we purchase a 12-month insurance policy on November the 1st. Cost is $3,600. We debit the prepaid asset, prepaid insurance, for $3,600 at the end of 2 months. We got it on November the 1st, so November is there, December is there. At the end of 2 months, insurance, $600 worth of insurance has expired. The entry would be to debit insurance expense for that $600 and credit prepaid insurance. Now the balance in the prepaid insurance account is down to $3,000, and every month we would be able to reduce that by $300 until we get down to zero. And every month we would add it. We would debit the expense account, insurance expense, for that same amount. Again, an income statement account, an expense account, and an asset account are involved. Another type of deferral is a deferral of revenues. For example, we might receive advance payment for services or products we haven't provided. The advance payment is debited to cash. We receive the cash, and it's credited to a liability account, usually unearned revenue of some kind. So let's say we receive $12,000 for the next year's worth of magazine subscriptions. We would debit cash and credit unearned subscription revenue for $12,000. And then at the end of the 1 month, we would adjust that because 1 month of those subscriptions had been provided. So we would then debit the liability account. We'd reduce that liability account by $1,000, 1/12 of the amount, and we would credit the actual revenue account, subscription revenue, we'll say, for the same amount. Okay, accrual entries do not have a prior payment. No cash has been exchanged. In this case, let's talk about wages. This is an expense, an accrual of an expense. We have a worker that earns $100 a day. The year ends on December the 31st, which is a Wednesday, and the employee has worked the entire week. At the close of business on Wednesday, the company owes that employee 3 days' pay, or $300. No cash has been exchanged. We haven't made any entries because we don't do payroll in the middle of the week. But we do need to accrue this expense. So the entry would be to debit wages expense and credit liability wages payable. Interest is another expense that accrues. Let's say we have a loan that we owe somebody and it accumulates $500 in interest every month. At the end of 1 month, we would debit interest expense and credit interest payable. Again, we're including an expense account on the income statement and a liability account on the balance sheet. And then we can also accrue revenue. Let's say we lent money out instead of borrowed money. That loan earns $500 a month in interest. So at the end of 1 month, we would debit interest receivable, debit the asset, and credit the revenue. The same thing would happen if we had billed for a service, but we we provided a service but haven't billed for it yet. We would debit accounts receivable in this case and credit services revenue at the end of the period. Let me show you something. Hang on a second. This is something that I call the adjusting entry grid, and so you have to ask yourself a couple of questions, and then the grid will help you solve the equation, if you want to call it that. The first question is, has cash changed hands? Well, if cash changed hands, then it's a deferral. If it hasn't changed hands, then it's an accrual. So let's say it's an accrual. Cash has not changed hands. So then we ask ourselves the next question: who is paying? Are we paying them? We debit an expense and credit a liability. This is, and I think of wages that we talked about a minute ago. We would debit wages expense and credit wages payable. If it's utilities, say we haven't received a utility bill, but we estimate the amount of the utility expense, and we debit utility expense and credit, in this case, probably accounts payable. If it's interest expense, interest payable. If the answer to question 2 is that they're paying us, then it's revenue, and we would debit a receivable. Think of interest receivable and interest revenue. Or if it's revenue that we've earned by providing a service, then we would debit accounts receivable and credit services revenue. The other possibility is the answer to question 1 is that yes, cash has changed hands. Then we ask the same question: who's paying whom? If they're paying us, and we're going to talk about this, hang on just a second, let me get my cursor back visible to me. There we go. Okay, the other possibility is that it's a deferral, and then we ask ourselves who is paying whom. If we're paying them, this is a deferral. If we're paying them, then it's an expense. So in this case, we would debit an expense and reduce an asset, credit an asset, usually a prepaid. If they're paying us, if somebody's paying us, we're going to debit or decrease the liability, unearned revenue of some kind, and credit the actual revenue account. And now we'll talk about the other possibility. There is another way that these first entries could be recorded, and we'll talk about those in just a second. Before we do a lot more, let's look at a quick example. Of course, the date is going to be, we'll use December the 31st because we know that's the end of an accounting cycle. And let's talk about supplies. Say we had sometime at the beginning of the year, or the beginning of whatever accounting cycle we're talking about, we had $2,100 in supplies in the account and in our closet. And then we purchased $800 more. So that's the actual account balance. We are at $2,900. That's what our balance is. Well, we go to the closet and we count the supplies, and it turns out that we only have $1,200 worth of supplies in the closet. This is the balance we actually want. This is what our account has in it. This is what the closet has in it. So we want to adjust our paper work, our account on our in our books, down to equal what's in the closet. So the difference between that is $1,700. This is the adjustment needed, and this is the amount that our balance is going to be. So if you hang on a second, let's look at it as a T account. Here's the supplies account, account number 126. I just put the 126 there because it doesn't really matter, but it starts with a 1. Our beginning balance is $2,100. We purchased during the year $800 worth of supplies. So our account balance now is $2,900. Debit balance, of course, is an asset. We know that we want our ending balance, our adjusted balance, to equal what's in the closet. We want it to be $1,200. So I need to get from $2,900 to $1,200, and the difference is $1,700. So that's going to be my adjusting entry. That's what I'm going to make my adjusting entry as. So I'm going to do supplies expense, 1,700, supplies, 1,700, to adjust supplies account to actual. And you could say anything to record supplies used, which this is what we're talking about, is how many supplies were used. Let's look at an unearned revenue situation. Let's think about magazine subscriptions. We've received $12,000 in advance payments. There was no beginning balance, but we received $12,000 during at the beginning of November for a 1 year's worth of subscriptions. At the end of December, 2 of those months have passed. And so that's $1,000 a month. 2 months have passed, so a $2,000 adjustment is what we need. The corrected balance of that account should be $10,000. One more time, looking at it as a T account situation. Here we have unearned subscription revenue, the liability, and subscription revenue, the revenue account. We received $12,000 on November the 1st, and that is for 12 months worth of subscriptions. At the end of December, 2 of those months have expired, and so we have earned $2,000, or 2 months worth of that subscription revenue we've earned because we've provided those subscriptions to the purchasers. So that $2,000 is debited to the unearned account, to the liability account, and credited to the revenue account. So my entry would reflect that, a debit of $2,000 to the liability account, a credit of $2,000 to the revenue account. This is the adjustment for a deferred expense and for a deferred revenue. If we think of an accrual, this is an accrual of an expense here. Let's say somebody earns $100 a day, and they worked Monday, Tuesday, and Wednesday, the last 3 days of the year this week. We haven't done payroll, so we haven't recorded anything. We need to record $300 worth of wages. So that would be an entry to record wages payable. Now, if you think about it, in January, when I pay my wages, we're going to say that we're going to owe this person $500. This is in the first week of January, but they've the wages accrued is $300, so the expense in the new year would be the difference. So in the new year, we'd say we pay this person $500 on January the 2nd, which is Friday when we do payroll. So 2026. We would debit wages expense only for the expense in the new year. We would debit wages payable for the wages that we had accrued last year. Oops. Let's see. Do this a little better here. And then we would credit cash for the payment. If I could type without making mistakes, it would be better. But you can see we credited wages payable, a liability at the end of last year. Now we debit it, so that wages payable doesn't exist anymore. The entry is, that account is at zero after January the 2nd. But at the end of the year, we had this liability, and we recorded the expense for that liability in the prior year. This is an accrual of an expense. For a revenue, it would just be, we would debit a receivable and credit a revenue. And at the beginning, when we recorded the receipt in the new year, we would just debit cash and credit the receivable.